Let's take a look at the current state of payments. As per a Payments Canada report, there's been a 53% decrease in cash since COVID. And out of all payment volumes that occur, only 10% occur in cash, which means society is already moving towards a cashless state and we're accustomed to digital payments. Bitcoin is just another evolution of these digital payments. Now, when a consumer uses a card, let's say at a grocery store, let's walk through the process that they go through to make a transaction or a payment. So they walk to the terminal or the till, and it shows the amount that they're meant to pay. They tap or insert the card. The terminal displays an approved message. Within their bank app or their statement, it says as a pending transaction. And then a few days later, that pending transaction turns into a confirmed transaction. Do you know how this works? There's actually a lot that goes in the background, and let's jump into that. So it's important to actually discuss who is involved in card processing. And there's a variety of parties. There's a customer that's using the card. There's a business that's accepting the card. There's a business's bank known as the acquirer. There's a card network that's providing the payment infrastructure. So that's Visa, MasterCard, Amex are examples. And there's a customer bank that's actually sending the payment, known as the issuer. For simplicity's sake, I have not included the payment processor to make it easier. So this works in 3 steps. There's authorize, authenticate, and settle. In authorize, the business is requiring approval from the customer's bank to charge their card. In authenticate, the customer's bank verifies the card information and lets the business know that they can charge the card. In settle, the funds actually move from the customer's account or the customer's bank to the business's bank. Now that's just a high-level overview. In terms of the detailed view, I've broken down what authorize and authenticate and settle looks like. So we'll start with authorize. So the customer goes to the business and is looking to pay. So they pay with card at the business. The business sends the information to the acquirer, which is the business's bank. That bank sends the information to the card network, and the card network sends it to the customer's bank requiring authorization. So this is the initial step. Now comes the authenticate part where the bank, which is the customer's bank, reviews the information and either approves or declines and sends that response to the card network. That response goes to the acquirer, which goes back to the business. And then at the terminal, the sale is either completed or canceled. Again, payment processor has been left out for simplicity. So far in this, the customer was able to pay for their good and they've walked away from the store, but the money has not yet moved. That's what occurs at the settlement phase. So every day, at the end of the day or end of couple days, the business sends a batch of all the approved transactions to their bank. Their bank sends a batch to the card network, and the card network sends it to the customer's banks. Now the customer bank transfers the money intended minus the interchange fee back to the card network. The card network transfers the funds minus their fee, and the bank transfers the funds to the merchant minus their fee. So the merchant doesn't get the full amount, they get a partial amount of what they're owed. And the bank, the customer bank will post a transaction on the customer's account when all of this completes. So that's the reason why transactions appear as pending in your bank account and take a few days to settle. It settles only when funds move from the customer's account to the merchant's account or the business's account. When it comes to processing fees, when you buy something for $100, the business does not get all $100. They have to pay fees. Let's look at what fees are being removed from the $100 of purchase. So $1.80 goes to the customer's bank who issued the card. 15 cents goes to the card network. Around 30 cents goes to the payment processor. The business only ends up getting around $97.95, and they lose anywhere between 2 to 4%. Now these values here, take it with a grain of salt because they vary based on the provider and they're lower on debit card. So this is just a ballpark number for the processing fees. Now, fraud and chargeback is also a painful attribute that merchants and businesses have to deal with when accepting credit card payments. Fraud occurs when someone steals an individual's identity or their credit card information to make unauthorized transactions. Now, when the account owner realizes fraud has occurred, they inform the bank immediately. Now, the bank, what they do is they charge the business back for the amount being disputed. The business can provide proof to challenge the chargeback, but a chargeback is possible even without fraud occurring. It's called a friendly fraud. That's when you decide to be a jerk and you lie to the bank that the business cheated you, as in you got a bad product or didn't receive it or other reasons. So when you lie to the bank charges the merchant. Now the merchant is liable. If the business can't provide proof or the merchant can't provide proof, they have to not only pay you back, but they also have to pay a bank a fee. So they get hit with a double whammy. Now the cost of chargeback is pretty painful for businesses. First, they lose the product or the service that they sold to the customer because the customer now does not return it. They have to pay a chargeback fee, whether it's by the payment processor or directly from the bank. There's an operational cost involved to gathering the proof, whether that's the time it takes the team members to put the information together. There's reputational damage. It can be seen as poor customer service from the eyes of the payment processor and the bank. And if the merchant is deemed as high risk, the payment processing fees can increase. In terms of some stats about chargeback, a total of 615 million transactions were considered as chargeback in 2021. And that cost businesses roughly 117 billion. That's a massive number. And it's predicted that in 2023, 60% of North American chargeback will be cases of friendly fraud. Now, to add on to all of this, the business is losing purchasing power because when they sell their goods or services, they're typically receiving the local currency, dollar, euro, pound, rupee, yen, and so on. But these currencies are all subject to inflation, meaning the cost of goods and services increasing, which means the decreasing purchasing power for the business. If you look at the inflation rate, this is as of May, America and Canada, it doesn't look too bad. When you compare Argentina, Venezuela, and Lebanon, where they clearly exceed 100%. Now, could a business survive when inflation's above 100%? Unlikely. So when we recap the challenges of the current state of payments on businesses, they're relying on third parties to process payments. So that's the card networks and banks. They're liable for fraud and chargeback, which eats into their revenue. They also lose revenue due to fees that they have to pay for accepting card payments. They're also losing purchasing power due to inflation, and they don't even get the money immediately. In order for transactions to settle, they need to wait anywhere between 24 to 48 hours to actually receive the money. Although accepting card payments provides flexibility to the merchant, it does eat in their margins and puts them in an unfortunate situation.